I guess the asset selection or the wrong asset selection is probably the biggest thing. And that might sound like sort of low-hanging fruit, like an easy answer, but I see that a lot of the time. I'll give you a quick example. I was sitting with some prospective clients and they spoke about some of their learnings as investors over the last sort of 5 years. And they selected a particular type of asset, so in this case, apartments. And when I spoke to them around what their next purchase looks like, they were very much leaning into the same type of area, same type of product, apartments, again, within a drive, right? So that asset selection piece, I think, is quite important because that can derail you from the very beginning.
Hello everyone and welcome to our next episode in our property investment journey, building generational wealth with strategic property investing. This Wednesday, along with me, I've got George Sandeep, founder director of James Chase Buyers Agency. I'm myself Sandeep Jagtap, director of Finsource Mortgage and Finance Brokers. And George, this Wednesday we'll talk about how to build a portfolio and investing with a purpose.
Absolutely, Sandeep. Good to see you again. So I think we covered off some of the basics in our last discussion. So now we're going to get stuck into building a portfolio, what we need to look out for, what we need to account for, what can go wrong, what can go right.
Yeah. And before we get started, George, just a disclaimer for everyone. This is no financial advice. Please do not treat anything we discuss here as financial advice. Everybody needs to consult their own accountant, financial planner, and make sure that they are getting personalized tax and financial advice before they start investing. What we are talking here is general ideas, general strategies. We have worked with a few clients and their accountants and their financial planners, and how we have helped people build their portfolios, right?
Absolutely. And typically that always starts with a strategy.
Yeah.
So when we are talking to clients, and I know you do this from a finance perspective, and I approach the same from a property or an acquisition perspective, we want to understand what is it that they're building towards, what's their end goal. And that way we can carve a plan out, a strategy for them accordingly.
Great. And so as our name of this podcast suggests, we are trying to build generational wealth with strategic property investment. And that term, strategic property investment, is pretty key. And in that strategic property investment, there should be a starting point, George. So today, in our first episode, after our introductory episode, we are talking about where do we start, where it all starts. How do I start? What am I trying to achieve? So, yeah, investing with a purpose. So what would you say? How would you typically suggest someone, a client walking into your office, how would you sit down with them and think as to where to go, how to go, and where to start? What should be the next step? How should we approach the step further?
Absolutely. Absolutely. So I guess with my investor hat on, Sandeep, so it's very important to understand before anything starts at the absolute outset what my position is, from a financial perspective, but also what my appetite is from a risk perspective, because ultimately that will become a bit of a roadmap for me as an investor to be able to build my plan and my strategy going forward. The best way to do that is to obtain advice from professionals. So who knows your numbers best other than you? It would be your accountant or your financial advisor. Sitting down with them will give you a clear understanding of where you are financially, what you can take on, but also what you should avoid. So that's the very beginning.
Okay, so that's the starting point. And then I would probably, as an investor myself, I'll think, what's my end goal? So what do I want to achieve? How much time I have got left? What is my risk appetite depending on my age, where my family life is at the moment, how old are the kids, what's the plan, and whatnot. So we got a starting point, we got an end point, and we have to sort of think what can be realistically achieved during that. So that's where I think that's a good point, George. Sitting down with them, say, for example, a couple walks into the office, they are 35 years old, have their principal place of residence, and want to sort of think of investing.
Yes.
So how would you typically guide them if a 35-year-old couple comes in to your office and think, George, we've got a principal place of residence, we need to start investing, we just have 2 kids and we want to build generational wealth for them. So how would you sort of start the discussion, and how would probably a strategy session go like?
Yeah, good question, Sandeep. So typically we want to understand where they're at in their journey, right? So in that scenario, we want to know sort of the financial position that the couple are in. Are there any major sort of milestones that are coming up in their life? More children, any major holidays, life events? Is private school the path forward for their kids as they get older? But then we also sort of then look at the end point. So when it's all said and done and they're at retirement, what's the purpose of their investing, right? Is it so that they can live abroad for a number of months a year? Is it so they can draw an income of an X number of dollars? And once we know what that end goal is, we then reverse engineer the plan. So we look at that and we say, okay, well, this is where you are at the start of your journey, and this is where we need to get to. What are the steps we need to take in between to try and close that gap? And ultimately, the strategy piece is very important because we start with the first step, and that first step needs to be the correct one to get us to the second step. So we always look at what we're doing now, but we have the next step in mind.
Yeah, because one wrong step can delay your next step and maybe alter the plan or take a lot more longer to build the assets that you want to build to have that amount of wealth when you plan to retire.
Absolutely. So using that scenario you provided as an example, so if we're at the start of our investment journey, if the couple that we were talking about is at the start of their investment journey and they have a longer timeline, they've got young kids, then we really sort of want to focus on growth assets for them, because ultimately the rate at which property would grow, especially in Australia across sort of capital markets and some metro markets, will be at a much faster rate than what most people can save. So the initial focus would be growth assets, of course, with a bit of a balance on yield. Then we will look at that and go in about sort of 12, 18 months' time. Have we generated enough uplift, and can we financially go again with our next purchase?
Great. And look, George, that's very good point you raised there, that growth in that asset is important. At the same time, we are mindful of the yield, because when we are building these type of portfolios, important thing is to sustain while we build. So you don't want to compromise your lifestyle. You don't want to delay your holidays. Everything can be a part of this bigger plan so that people can have their milestones as and when they come, and at the same time sustain the portfolio as they build. So that cash flow is really important. So that's where I think, yes, people may want to buy few $1 million properties without knowing where they stand, what their risk appetite is, how their cash flow is, and that can be in trouble soon.
Yes.
And the plan goes out of the window, right?
Absolutely. And it's an important point you raise, because investing, even though we take a longer term view and we're sort of doing it for later in life, in this particular case, your current lifestyle at the moment should not suffer, right? So you should not be in a position of stress and constant worry and procrastination. So if you're investing in that sense and sort of you're under that sort of pressure, then something's probably not right. So it very much should not compromise your current lifestyle.
Yeah, and that's where I think, when we sit down with the clients for this strategy session, it's always good to have other professionals on board. We have you guys, buyers agents, accountants, if they have a financial planner, having all of them on one Teams call or one office, and understanding from the clients as to what their wish list is. That's the starting point. That I am 35 years old. At the age of 65, I want to retire. And while I retire, I want a cash flow about $2,500 a month.
Correct. Right? Absolutely.
And sorry, $2,500 a week.
Yeah, that's right. So that way they can sustain their particular lifestyle if that's the target that they've set. And I think ultimately, as investors, we've evolved through that timeline. It's important to sort of look back and realize where we're at, and are we actually making progress towards achieving that goal? Because often the timeline will be quite long, and our goals can change. Of course, our financial position as individuals and investors is not going to stay the same. You would expect things will improve. You'll have your ups, you'll have your downs. And that way your plan, if it needs to, can also have some slight adjustments to make sure that the journey is as smooth as possible.
Yeah, and I think, George, if I'm 35 years old, I want to retire at 65. I've got a good span of 30 odd years, and to build those assets in, if I need $2,500 a week, probably $125,000 a year in passive income, how many assets I need to build, and at retirement to pay down most of the debts, so that that cash flow is real cash flow for you without relying on your super only for retirement, right? So typically, if I have to buy 5, 6, 7 properties and then hold them for a period of time, add value to the properties by being a little bit creative, adding grannies wherever possible, subdivisions, whatnot, those will be again part of further strategy. And then possibly hold them for a period of time. As you rightly said, property in capital cities have done really well and grow really faster than one can save. So I think that time span, having a strategy, having timelines for every next acquisition and what type of acquisition, which state it is, what type of structure it would be, is very important. And that way, just buy, add value, hold, and then sell and pay down the liabilities would probably a good strategy as an overall higher level strategy.
Absolutely. And what you've touched on there is quite important. It's basically sort of being aware of where you are in your investor journey, right? So in that scenario, again, so the couple in their early 30s, it's safe to say that they're in their acquisition phase. So as sort of life moves on and they've started to accumulate some properties, then they would move into the consolidation phase. So the consolidation is basically around extracting as much value as possible from these properties. Are we able to draw more than one income from every asset in the portfolio or a few assets in the portfolio? And then with a view of the retirement phase in mind. So now a lot of the time investors do obviously dip, as you would know, in between one phase and the other. So they can go from, acquisition to consolidation and vice versa. But as sort of the years are getting on and you're sort of getting closer to that retirement age, then you want to sort of really look at your portfolio and go, okay, we're getting close to that time now. How do we transition from where we are into that cash flow that we were aiming for? And some of it could include things like selling down some of your assets and even exploring different asset classes.
Yeah, and rightly said, George, it cannot be one asset in one particular geography. As you go on your journey, there will be different states, different types of incentives to invest in certain areas, right? Like classic example would be the Olympics in Brisbane. Mm-hmm. That has driven Queensland property prices to the next level in the last 5 years, and people have made a lot of money. We have invested in Queensland and made a lot of money in the property in the short term, which helps us to sort of build that equity faster, yes, which allows us to extract the equity and buy the next property. So investing in the right markets at the right time can lead you to your next step earlier. Would you probably agree with that, or what are your thoughts on that?
Yeah, I completely agree. I think the asset acquisition and the right type of acquisition makes a big difference, especially sort of when you're at the start of your journey. So we often talk about things that can go right, but also there's a number of things that can go wrong, I think, which we need to be mindful of, right? So and the biggest thing is the asset selection. So if an investor is entering into the investment space and has the intention of growing a portfolio to fulfill a particular purpose, then you sort of want to avoid some basic foundational mistakes. So a lot of the time, doing the right proper due diligence will ensure that your purchase is aligned to the goal that you're working for. And also just the asset selection itself. Am I buying the right house? Does it have the right growth fundamentals? Is it getting a good balance of rental yield? Is it in a location that is projected to grow, as opposed to a market that was hot, 12, 18, 24 months ago, and you're sort of coming in on the tail end where the growth cycle is near its end. So the acquisition and the right asset selection plays a key role. Then that way it sets you up for success as you go along your journey.
That's an interesting point, George, because yes, Queensland, as I said, has done well and continues to do well, and the Olympics are a little bit away, and there's a lot of infrastructure work that's happening. However, a lot of people have been investing in Western Australia and South Australia for some time, and the markets have done really well over the past few years. However, scary territory to go in at this stage, right? And those are the things which one need to be mindful when building a portfolio, is just don't follow the crowd. Your strategy with your accountant, with your financial planner, with your buyer's agent, with your mortgage broker, we know where we are, what type of property. These people are experienced enough. People like yourself are experienced enough to tell them which markets would be good to go in that type of property that we are looking at. So if the accountant says both of them are paying huge amount of tax, in the short term, we should save some tax while we build capital growth.
Yes.
And for that, we don't mind property which is costing a little bit to hold on. However, the capital growth will be much more than what it costs to hold on. So that's why I think that is a key point where people need to sit down with people like yourself, people like the accountant, people like us, saying, hey, this is where we are. We are 35 years old. We have got a principal place of residence. We have got saving about $100,000. Mm-hmm. This principal place of residence we bought 3 years ago. and we want to start our investment journey. So typically, I would probably say I would probably not touch that $100,000. That will be my safety money because life has got its challenges. Things can change. Somebody loses a job, something may happen. So I'd probably, if the principal place of residence is 2-3 years old, probably then would be good point to buy extract equity from the property for towards the deposit, and then have as much lending on the investment properties, which will be a good tax incentive, which the accountant would be happy with while they build the assets.
Yes.
And go on their capital growth. So that's where one would come to you saying, George, now I've got this couple. I think this is the strategy at this stage. We want to acquire X number of properties every 2-3 years. We would like to buy some properties in their acquisition phase. And as a first step, I would probably say, George, this is the budget. We have extracted the equity from the principal place of residence. We are ready with the pre-approval for the next one. Mr. Accountant thinks that this type of property is what they would want to buy, and I send them your way. How would you then approach the buying process or building the first asset process?
Yeah, absolutely. So we would then, reverse confirm everything with the client. Just we want to ensure that they're actually understanding what's happening around them, right? So they understand what the accountants told them. They understand their borrowing position from speaking to your good self. And then ultimately, once we've cleared that off, then we would formulate some opportunities for them. So what I mean by that is we prefer to work obviously to a scope. So that way our acquisition and our search process along with the customer journey becomes a lot smoother. So we present them with some options that are aligned to the criteria. So for example, if they need to achieve a certain amount of capital growth a year based on the advice they've received, or a rental return so they can sort of service the loan in this occasion, then that will basically have an impact on the markets that we could search in. So we would present them some markets. We would talk about why these markets align with their strategy. So from a growth perspective, what's happening in those areas? Is there infrastructure investment happening from local state government perspective? Is there strong owner-occupier appeal as well? And from a lifestyle element, why are people attracted to that area? Why do they want to live there? Are there schools around? Are there close amenities, public transport ease, and employment, of course, right? So then we start to sort of build a bit of a picture and show the investor why it's an investment grade area. And then from there, we start with the search process. So the search is typically a combination of pre-market opportunities as well as on-market opportunities, because we don't want to rule those out as well.
And then you would do all your due diligence and then present the property to the clients. So what sort of typical thing goes into your when you get the scope from the client to when you present the property? What sort of steps would you go through to make sure that property fits the bill what they're looking for?
Yeah, absolutely. So good question. So ultimately, we want to know that these areas are investment grade, or more so sort of give the client comfort that we are talking to them about investment grade areas. So over there, we look at things like, again, so investment fundamentals. So what investment is being made into these regions? And we look at that from an LGA or a region perspective. So is there local government investment? Is there housing? Is there new medical facilities, education facilities? Now, and we want to look at sort of the numbers, right? So typically you sort of look at infrastructure improvements. So when you see sort of road improvements and rail infrastructure coming in, then you know that the government has forecast strong growth in these areas. Then on top of that, we want to know, okay, so now that families can come here and they live here, what's the appeal like? So what's the ratio of owner-occupiers versus renters in a particular area? To your point earlier around following the crowd, there are some suburbs and some streets specifically in quite a few areas where you sort of have a look at the ratio of owner-occupiers to renters, and investors own 70% of that, right? So what does that tell you? So when you are going to basically exit from that investment, then let's say, half a dozen other investors exit from that same market at the same time, buyers, especially owner-occupier buyers, are going to have options. So you're going to have to compromise on your sale price. So we want to avoid that. So we do that due diligence from the start. Then we have a look at environmental issues, obviously, sort of flood zones, fire zones. We look at sort of elevation of the property. We want to buy on the high side typically and not below street level. And we talk through and make sure the client understands all of this due diligence. We look at socioeconomic factors. We look at demographics. So it's quite comprehensive, but we explain that back in quite a sort of easy to digest way. We provide the client with a report as well, covering off the same things. And that ensures that we're buying in an area that is very much investment grade. And then from there, we move down to asset level, so property specific.
And then you'll present a property, client likes the property, we sign the contract, I'd probably process the finance, the property settles, here we go, first step in the investment journey achieved. Now, that's said and done. We don't want to stop there, or we both as professionals don't want to be transactional, that the client walks in, I get a loan for a property and you buy them one property and they go away. So for our audience, what us do together, for the clients we help together is typically I would not mind to attend the meeting with their accountant at their tax time to see where they are at tax time every year. What are the accountant's thoughts on what this should be their next step, how things are moving. Every year we will do the review of their financial position, the equity position, the loan position, and see if any more equity is available in the property which can be extracted to get to the next step. So it's an ongoing process. Once the client comes in, they sign off, they are happy with our strategy, they are happy with the plan, and the plan is not set in stone, right? We have an outline, and things change.
Of course,
things are don't go to plan all the time.
Of course,
and that's where I think you would do the same for our typical clients. You always call me saying, "Hey, this client, we've done this last year, and what are your thoughts? Have they got any borrowing capacity? I think they're ready for the next one, and I can find something in the next." So I think that's where professionals like us working together can help people understand. Their life is busy, and they understand, okay, we are ready for the next one. It's a plan to take our next step in our process. So what would you do typically after the property settles? How would you track and how would you approach the next step based on what the big plan is?
Yeah, absolutely. So we want to, I guess, yes, the transaction happening and the property settling marks the end of that milestone, but it doesn't stop there, right, as you're alluding to. So we need to make sure that the property is running quite efficiently. So when we're doing our review, whether it's sort of quarterly, 6 monthly or annual, we want to ensure that the income that's coming in is in line with market, but also our expenses, right? So people often ignore that side of the balance sheet. So we want to ensure that our holding costs, whether it's insurance, property management services, etc., are in line to market.
Any maintenance coming from time to time?
Absolutely. So is the property costing you more than what it should, right? So, and we get a good picture of that obviously as part of the due diligence period. But if things change, then we want to know that your investment is basically fitting its purpose. It's fit for purpose. So if it's costing you more than it should, then again, we have a look at why that is. Is it a bump in the road or is there a change that we need to make? But typically, sort of speaking, when we are sort of at that 12-month mark, we have a look and just make sure that the property's performed from a growth perspective as expected. We check in with our clients as well, just to understand how things are going with them on a personal level. Is work still okay? Have they had a promotion? They were thinking of buying a second within the next amount of time. Do they feel that they're on track? And ultimately, going back again to the point we made at the start, is it needs to work for them, right? So if initially their plan was to buy something in 18 months and however they're in a tight space at that point in time, then you might sort of reassess that timeline of
24 to 36 months, but next step,
absolutely,
when they're ready for it.
Absolutely. And then conversely as well, if they've just gone through a number of promotions since we've last sort of connected and they can, accelerate their timeline, then why not? And again, we would, as part of that, we would revise their plan.
Yep. And rightly said, George, things change. We set a plan and we evaluate things from time to time, and things change a little bit. However, we don't deviate from the plan too much. So a typical client who wants to build generational wealth through property coming to us as a client probably have 3-4 properties. By the time they have 3, 4, 5 properties, depending on their risk appetite, their borrowing capacities and all, and they build about 200K to 250K in their super, that's when they're ready for a property in super. Self-managed super fund, that's a good strategy as well. We do a lot of that for our clients with our accountants and financial advisor friends. And having a self-managed super fund can accelerate growth of your super. So those are the things I think would form a part of that overall strategy as such. However, before we close this episode, George, the final and a key thing I would like to ask you is about acquisition and what can go wrong and how can that derail your strategy as such. So what are the typical things you see, typical mistakes you see in people do, or what can go wrong in a property acquisition that one needs to avoid? Otherwise, the entire strategy goes out of the window.
Yeah, very good question. So I guess the asset selection or the wrong asset selection is probably the biggest thing. And that might sound like sort of low-hanging fruit, like an easy answer, but I see that a lot of the time. So to give you a quick example, I was sitting with some prospective clients and they spoke about some of their learnings as investors over the last sort of 5 years. And they selected a particular type of asset, so in this case, apartments. And when I spoke to them around what the next purchase looks like, they were very much leaning into the same type of area, same type of product, apartments, again, within a drive, right? So that asset selection piece, I think, is quite important because that can derail you from the very beginning. And then also your due diligence. So if you are not capable of doing proper due diligence, and that's some of the stuff we mentioned earlier around sort of investments in the area, why do we believe this area will perform and grow over the long term? But it's also sort of going down, having a look yourself, getting some boots on the ground, driving through, talking to locals, go through the coffee shops, get a real sense of that area. And that's part of your due diligence as well.
Really important, yeah.
So that's very important. And that can, again, derail you because the last thing we want is to go into a market where we have all of these goals, these ambitions, we're in a financial position to do what we set out to. But if you buy in a market that doesn't grow and you need it to, then that could be quite problematic.
Yeah. And look, George, other thing which I have seen or heard from investors where they think and we see the mistakes every day, is following those videos on social media and going to invest. Like, I bought 17 properties in 24 months and whatnot, ridiculous things we hear. And those people who are selling certain stocks and saying, you can only pay 5% today and worry about it 2 years down the line. But no, my acquisition is delayed by 2 years. So typically buying in, following the crowd and going to Western Australia when it's too late.
Yeah, agreed.
Right?
Agreed.
Or being too negative about Victoria. Yes, Victoria had its challenges, but then every market will have its strength. So I would probably think in my strategy as an investor, I would look at fundamentals of the area. Is it a mining-driven economy? Mm-hmm. Is it an economy like Melbourne, which is more driven by the education system, or Sydney, which is really the financial capital of Australia, or then Brisbane, which has got a lot of incentives for people to move there.
Yes.
And when I talk to about Queensland, I'm not talking about all the regional towns, but probably typical an hour and a half from the major cities would probably be a good strategy in the early stages, which will give us good capital growth, because that capital growth is key to help you buy the next asset and take the next step forward, right? Of the plans, home and land packages, which you don't know have got exact timelines, right? Or people selling you properties by the thought of, because this is a new property, you'll get depreciation. And those are the mistakes we have seen a lot. Like, depreciation is not a strategy. It's just a part of a plan, right?
Agree.
And it's more about the growth that you get, which will allow you to acquire. So our strategy in building this generational wealth is all about acquiring fast and having that capital growth, which will allow you to sell a few assets at the time of consolidating and paying it down, so that all your debt is paid off, and that's where your cash flow starts to come in, right?
Absolutely. So it's very valid, and just ensuring no matter what you do, I guess if you are at the start of your investor journey and you're listening to this, don't necessarily follow the crowd, to your point, because what's right for me might not be right for you, or vice versa, and it might not be right for the next person. We all sort of come from a different, I guess, position, whether it's sort of financially or any assistance we've received along the way. So what is working for one particular person, whether you've downloaded a white paper, listened to a podcast, it doesn't mean it's going to be right for you. And that's where, going back to that advice from whether it's your accountant or your financial planner, becomes really prevalent.
Yeah. So, George, I think we have covered a high level how someone would build a portfolio, how to really think about how the steps and how we go about building generational wealth through property. In 2 weeks' time, we'll come back and talk about what types of properties. A good topic for you to guide our audience on what type. And no property type is good or bad. It's just that what type of property is going to be good for you at that particular time. So next episode in 2 weeks' time, we'll come back with what type of properties and how we invest in various types of properties at various times.
Look forward to it, Sandeep.
Thanks, George. And thank you everyone for listening in, and see you again in 2 weeks' time.